Hey everyone, welcome back to the podcast. Today we are excited to have a special guest with us. We would love to welcome Matt Doyle with Guild Mortgage. Matt, thanks for joining us
Thank you
today.
so much.
Thank you guys for having me.
We're excited to have Matt here. He is a preferred lender of ours and really helps us out. He's amazing, and he's going to talk to us about a few different things. One of the things I would like to mention starting off is why it's very, very important this time of year to connect with a lender. Even if you're not thinking about, buying a house till summertime, it's really, really important right now to engage with a lender so you can get the ball rolling and find out, what you're approved for, what you can afford. So, that's why we have you today, Matt, so you can kind of connect with us. And we're going to talk a little bit about some things that's on everybody's mind, which is mortgage rates. The Fed. And what does that mean? Is when the Fed meets and they cut a rate, does that mean that mortgage rates drop?
So that's a great question. And once again, guys, thanks for having me here. Super excited to be here. So the Fed does not directly impact mortgage rates. Mortgage rates are more so based off what's likely going to happen. Mm-hmm. The Fed determines what has happened. So that's kind of the clear difference between the two. It's like a weatherman saying there's a chance it rains Saturday versus somebody staying up said it's raining. Mm-hmm. So mortgage rates are going to say okay, based off of this report or these job numbers or the inflation, this is what's likely going to happen, and that's going to help give traders their insight into how to make their bets, mm-hmm. so to speak. The Fed rate itself dictates more of the cost to borrow money on a short-term fee. So that's going to affect more like a HELOC rate, your credit card payments, or interest rate on a credit card, as well as like car loans and stuff like that. So there is a clear difference between the two, and I feel like I'm falling asleep talking about this. I promise you, it is a lot more exciting.
It is important, and it's interesting. It's so fun kind of watching, because I feel like you've coached us real estate agents, mm-hmm. right? That it's leading up to the Fed's meeting, that it's really the week, 2 weeks leading mm-hmm. up to that. That's when you start to see mortgage rates go down,
yep.
typically. And people wonder that after the Feds meet, well, why is it that mortgage rates go up, not understanding how it all works and what's, that the bond market is and its impact
yep.
on mortgages, how that all works. And so it's nice to have experts like you educate us.
Yeah. And clearing up the misconception of when the Fed meets and makes a cut, people are expecting the rates to go down immediately when it's already happened because of the anticipation.
You guys have no idea how many calls and text messages I get. I mean, it'll be somebody I went to kindergarten with. I haven't spoken to in 30 years, and they message me, "Hey, Matt, how's interest rates?" I'm like, I don't even know how you got my phone number. But as soon as the Fed, cuts rates or raises rates, or they don't touch rates, mm-hmm. there's still a chance mortgage rates could go up, mm-hmm. down, or stay the same.
Yeah.
And it's more so based off the commentary after the meeting, mm-hmm. because the commentary after the meeting gives everybody that wasn't in those closed doors insight into what the Fed is thinking is going to happen next. Mm-hmm. So I know we have the Fed meeting later this week. So, if we go back in time a month, so let's say we're looking at February, you can sit there and look at the reports that are coming out in February to give the market's indication of what's likely going to happen when the Fed meets, this week. Mm-hmm. And we're not going to know what's going to happen after until the Fed gets up there and says, here's what we voted, here's what we're thinking, here's what was said, and here's what we think is going to happen in the future.
So with that said, and just from a buyer's perspective,
yep.
they're always trying to time everything, mm-hmm. right? So would you say, in your opinion, that it is best, or does it matter, should a buyer wait until after the Fed meets, or wait? And how do they gauge that? What is your opinion on that?
So every scenario is going to be different. Mm-hmm. The long story short, don't wait, mm-hmm. because mm-hmm. you might be sitting here, let's say you're watching this on a Thursday, and you're like, you know what, the Fed meets again in 6 weeks, I'm going to wait. But if your dream house hits the market mm-hmm. the next day, you're going to be sitting there and saying, oh my gosh, what happens? Should we wait? Should we make an offer to close in 2 months? Was mm-hmm. that going to help? 9 times out of 10, no. because let's say the Fed lowers rates by one cut or 0.25%. Mortgage rates already know what's likely going to happen. So if the Fed's set to meet, this week, there's a good chance mortgage rates have already factored in a cut or a lack thereof 2 or 3 weeks ago. So waiting is really just killing time.
Yeah.
What if you have a buyer that's not looking, they want to have a discussion with you now, just to educate themselves, kind of have a baseline of what they think they can afford, and the rates, right? And as far as locking in a rate, so how does that work? So when a buyer talks to you, but they're not looking to pull the trigger 6 months, 9 months from now, how do you lock them in on a rate, and when does that happen?
So I'm going to say for the majority of people, you can't lock a rate until you go under contract. Now, there are different scenarios we have at Guild where you can, lock and shop, but I don't advise that in our current market, mainly because the interest rates are projected to go down and not projected to go up. The lock and shop feature was really popular going back to like 2022. Almost said 2020. 2022 where rates were going up. So 9 times out of 10, you're not locked until you go under contract. And the reason that's important is you can lock for a certain number of days. Now, the longer you lock that rate for, the higher the cost associated with interest rate, or the cost associated with that rate lock. So you're going to have a lower cost if you lock for less amount of time. So let's say a hypothetical. Let's say we're sitting here talking in March. You want to buy a house in August. You're probably not going to be able to compare, rates with one company versus another because nobody knows what those rates are going to be in, 3 months, 4 months, 5 months, whatever. But I still advise talking to a mortgage company or talking to a loan officer and saying, hey, what's the difference in these hypothetical, scenarios if I was to buy a $700,000 house versus a $725,000 house? What's the difference in my monthly payment if my, credit score is an 800 versus a 740? What happens if I do 5% down versus 20% down? So you can still get so much information, regardless if you're under contract or you're looking at a house that weekend.
And I really like that because a lot of times when the clients come to us and the buyers come to us, they really don't have any idea of what they can afford and what the breakdown of that cost is outside of the cost of the house. So, those fees and those
Taxes.
those terms, the
Taxes,
taxes, the
insurance.
prepaids, all of that. They don't know. So I love it when a client connects with you because they can provide you with a price point that they're looking for, and you can do almost like a mock estimate, and it really breaks down what some of those costs involved.
Oh, 100%.
And it really clears things up for the buyer.
Yeah. So like a quick side story, the first time I bought a house, I wasn't a loan officer yet, but I was like around the mortgage industry for about a year and a half. And I remember thinking, it's like, oh, I know what I'm doing. And that's not today, just be very clear. This is years ago. And I remember going through the process, and I had no idea what I was doing. And I was, quote, in the industry. I was on the support side, the operational side. So if I had no idea what I was doing, just think the people that aren't actually in the industry, they don't know what's going on because most people don't explain this stuff. So I remember sitting at the closing table having no idea what was going on, had no idea if I was getting a good rate in the right loan program, what I was doing. So a part of my business, I like to call it the Wizard of Oz, is I show buyers behind the curtain. So regardless if you're buying in a week, a month, or 6 months or a year, talking about that mock example, we're going to build this out and I'm going to educate you on the process because I want you to enjoy the process. I want you to understand it. I don't want you having that feeling of being blindfolded trying to buy a house.
And then there's no surprises.
Exactly. Yeah,
I mean, we'll sit at the closing table, and then the lawyer's going over all of the different breakdowns, and that nobody wants the questions to arise at the closing table. So, a lot of times when I'm working with you, everybody is on the same page. Everything is so transparent, and they can anticipate. There's no surprises, and that's it's like magic. So I love that. I wanted to real quick go back to a question I have
Yeah.
that I think maybe a lot of people have regarding the Fed.
Yep.
And how often can the Fed cut rates or analyze them and make changes?
So the Fed meets a number of times throughout the year, and I should have researched that
Are
ahead
they
of time.
limited to a certain?
So no. So there's
Okay.
a scheduled number of times they meet. For conversation, let's say it's 7.
Okay.
Let's say for conversation, and please don't fact check and blow me up in the comments. Let's say they meet 7 times a year. So that is pre-scheduled. So they're going to meet in January. They're going to meet in March. So on and so forth. But there are times where, let's say, the markets are predicting, job data. Like this happened last year. Markets were predicting job data come out at X, and it came in so far below X that everybody's like, "This is a huge misread. Like this is a big deal. Like this happened last summer." And there was almost an emergency Fed meeting. Like that's what happened at the start of COVID back in 2020. There was an emergency Fed meeting. It's like, guys, stop your vacations, get to the office. We've got a, firestorm coming up. We've got to address this. So there is those random scenarios, but most time the Fed's going to meet, once again, for example only, 7 times a year. And during those meetings, they're going to review all the data that's happened, all the data that's come out, and then say, based off this data, should we cut rates once, twice, 3 times, 4 times, whatever. Now, one thing that's really important that I think a lot of people just don't pay attention to, 4 times a year, the Fed is going to do what's called the dot plot. And that's going to give an indication of how many cuts are likely going to happen by the end of this year as well as next year. So when that dot plot comes out, that's what a lot of people focus on because it's giving clearer expectations of what's likely going to happen in the future meetings.
Thank you. So
Yeah.
we, obviously Matt knows his stuff, so that's why he's here.
Yep.
And I always learn something when I talk to you, so thank you for that. But we want to talk a little bit real quickly, not quickly, but, about you and your business.
Yep.
So Barry's got a few questions for you to go over.
Why should a buyer go with you? And how are you different from other companies?
So I will say that Guild Mortgage is amongst the top mortgage companies in the nation. We have over 800 different loan programs. Most of your companies are going to have about 400. Now, I'm not saying that we're going to give you 800 different options when you decide to buy a house, but it does grant us the ability to offer more situations. So that might be a 10% down bank statement loan with no mortgage insurance. Other companies might require you to do 20% down. So there's going to be small, differences like that does give us the competitive advantage. I would say the thing that works really well for me and what I try to portray is I try to put myself in the buyer's shoes. So if I'm sitting there with a buyer and he or she is like, Matt, I'm trying to accomplish X, I want to be on that, that same side of the table with them. I want to be working through this. I want to be making sure they're comfortable, they understand what they're doing. I never want them to feel like I don't care. So that's what I like to think I do differently.
Yeah, and I can attest to that because when my clients have worked with you, you're always accessible.
Yeah.
And I mean, you feel
And you're 365 days a year, 7 days a week.
always accessible.
Always
you answer
available.
your phone, and you don't get that with a lot. So
So if someone wants to sign on and work with you, how do they get a hold of you?
So if you are ready to fill out the application, go to my website. That's mattdoylemortgage.com. That'll give you a link to fill out the application. If you're not ready yet, that is perfectly fine. You can shoot me a text or give me a call or follow me on social media. Across all platforms, it's Matt Doyle Mortgage. And my cell phone is 704-881-3308.
Just giving the cell phone out.
All right.
So, Matt, thank you so much for
thank you.
coming by and sitting with us for a little while and really giving us the goods on what's to come.
Yeah, of course. And you guys are awesome to work with, so thank you for having me.
Yeah, absolutely.
Absolutely.
Well, we'll see you next time, and stay tuned and make sure if you like what you see, comment and follow us and subscribe to our podcast.
Thanks, guys.
Thanks,
for
guys.
coming.